this latest webinar with me, Andrew Dawkins, and
myself, Rachel Blackhall. We also have a couple of extra guests today.
we have
Daniel Beaverlock. I'm here today. Only for a little while though.
And we also have
Andrew Derrington.
More about Andrew in a minute. Lovely to have you with us. And for those of you watching live, if you'd like to ask any questions, fire them over as soon as possible. For those of you watching the recording, too late. So, what are we going to talk about today, Rachel?
So the agenda today, we've got what's been happening at A.R.D. Consultancy, and Dan's going to take the reins on that one this month. We'll touch on the latest market update, and then we have our special guest, Andrew Derrington, with us, who's going to be discussing some of the products from Puma Investments. We'll round off with the Q&A as usual.
Okay, so starting with what's been happening with us.
What's been happening, Dan?
I'll go over to myself then. So we've had a few events in the last month, which have been quite well attended, which have been great. We've been trying to get these events up and running for a while now, but COVID sort of put a stop to it. But we've done our best to try and get a couple under our hats since that point, and we've done all right this at the start of this year. And the first one that I'd like to talk about is our partnership with Caledonia Gladiators. So we sent out emails via newsletters and via social media and whatnot to try and get some of our faithful clients over to one of the games. And we ended up getting just a tad over 30, I think, clients that participated in this event. It went really well. Went down to the Emirates Arena. We got a lovely coach from Falkirk for all those Falkirk natives. And we made it down to Glasgow. We had some lovely afternoon tea, some scones and some cakes and some tea and some coffee, didn't we, Andrew? It was very nice. And
we had scones.
Yes. And then we had some special guests with us. We were quite fortunate to have the head coach Gareth Murray and also the assistant coach Darryl Wood speak to us for a while. We just had a bit of a presentation from them just to discuss the Gladiators in general and how the sport's doing in Scotland, how well the team's doing. And then we also did a tour of the Emirates Arena, and I know that a lot of the clients that were there really enjoyed seeing the velodrome, which is quite special to see. And then finally, we actually watched the game. So all the clients got to enjoy the game. And the good news is that the Gladiators won the game. So it was a fantastic evening with everyone involved. There's some great feedback. We even got all the clients to get on the court there, as you can see in that one of those images there with the players, get a photo and whatnot. But it was a fun event. Hopefully we can have some more going forward. It was brilliant just to get the clients out and I guess see you outside of the office space rather than in the office all the time. So yeah, it was brilliant. Do you have anything to say about that, Andrew? Did you have a lovely afternoon? Did you enjoy it?
I had a lovely afternoon with the Rockettes.
There we go. There was dances too, yes. So we facilitate for everyone. But it was a great day. And then from that, we had another event, which was just last week actually, which was, I think you all know about our association with Larbert High School, and more so the Schools of programs, and mainly that of the School of Hospitality. So this has been in the works for a couple of years now. So we did want to stage something in 2020 when we first took on the sponsorship of the School of Hospitality, but then dreaded COVID came along and hospitality was the hardest hit, believe it or not. But Andrew, he stuck with the program over those years and also donated some aprons to Larbert High School and the School of Hospitality, which they will use throughout their 3 years that they'll be doing the School of Hospitality there at Larbert High. So it's a brilliant event, once again. Just to give you a bit of a background as to what the School of program is. It's been running successfully for a number of years, and it gives the students in S1, S2, and S3 the invaluable opportunity to specialize in the area of particular interest, and allows them to develop essential skills to ensure they thrive both in and outside of school. So the schools of that Larbert High have the School of Languages, Media, Basketball, Dance, Football, Rugby, Piping and Drumming, Pop and Rock, and of course the School of Hospitality. So at our event that we had last week, it was a bit of a spectacle with regards to these schools of, and we were lucky enough to have performances from the School of Dance, which were fantastic. The School of Piping and Drumming, which is Andrew's favourite, So if you ever have any gifts, piping gifts, CDs, soundtracks, anything like that, Andrew's favourite instrument is the bagpipe. So feel free to bring that along to any review that you come in over the next few weeks or so. We're going to be playing in the background probably too. He loves it. We also had a performance from the School of Pop and Rock. So there were a couple of singers there, student singers, and also a band that performed for us. We also had the School of Languages who made an appearance, and they hosted a special Spanish-themed quiz, which actually went down quite well, didn't it?
You came third.
You did?
Yes.
Yes.
That's quite
And Andrew's
nice.
Spanish. But the main attraction, of course, was the School of Hospitality. So it was all about them, and they were there serving food. They actually cooked all the food themselves. They prepared it all, prepared the venue, and it really was something to remember, quite memorable for us, but also more so probably for the students to be able to focus on what they've been studying over the last few years and whatnot, and put that into practice with a whole bunch of clients there, A.R.D. clients. And once again, to all those that attended, thank you very much. Without you, we couldn't host these events. Hopefully, now that we've got a couple in the books, we can get more and more of you to come along to these nights. I mean, I don't know why you'd say no to free alcohol, free food, and free entertainment. That word free is always good. So we've been busy over the last month or so. The school's been great. The partnership is very strong, and hopefully you'll see more of these events in the near future as we go along. I think that's pretty much it from me. I've spoken enough, haven't I?
Oh, that's fantastic.
Thank you very much for this update.
Back to business now. One thing that I'm not actually sure if we did communicate, but
Yes, we did. It was on the last webinar.
it was, right? It seems a while ago, but anyway. So A.R.D, which was formerly known as the Standard Life, their RAP platform was being updated. So we had some downtime briefly on that while they updated the systems, but pleased to tell you it's now back up and running with our whole new look. So yeah, business as normal with them, if it affected any of you.
Right. And then moving on then, so
Yes.
our favourite time of the year. So it's that time of the year when it's probably time to check, making sure that we've done all the financial planning that we possibly can for this tax year. So the UK is a bit of a weird place because the tax year runs from the 6th of April to the 5th of April, not from the beginning of the year to the end of the year, as you would think happens most other places in the world. So if you have a little look and make sure that you've taken advantage of the £20,000 ISA allowance for this year, and also then if you have any kiddywinks or grandchildren or friends that are classed as juniors, then £9,000 can be placed into their junior ISAs. Pensions as well, just have a check. Those of you that have income in terms of employment, then it gives you the chance to pay a significant amount even of your salary into a pension pot. And again, that payable from till the end of the 5th of April. And then for those of you that are making gains, I'm not sure there's been that many gains in the last year, but if you have capital gains, then the allowance is currently 12,300, which the Chancellor has deemed a good idea to reduce to just £6,000 on the 6th of April of this year. So good idea. Check if you're wanting to divest yourself of any assets using the full £12,300, and then off we go again for the start of the new tax year. State pension as well, just a quick one on this, maybe already too late, but check for those of you that haven't reached state pension age yet to make sure you've got a full state pension allowance and national insurance credits, because of the fact that we're changing the rules slightly, and it means we can't go back in time as far as we used to be able to do in terms of any missed payments. So anybody that doesn't have a full national insurance record to qualify for the full state pension, check, go onto the government website, give them a ring, find out how much you need to pay, and generally it's a good thing to pay any missing contributions. So those are the sort of things to be.
Yeah, we're having a look and trying to do as much as we can at our end, just making sure we've contacted you about ISA allowances and pension contributions and whatnot. But if there is anything that any of you want to contact us about, please do it ASAP, because although tax year end is next month. The providers do tend to have cut-off dates a lot earlier than that in order to get the contribution through in this tax year. So if there is anything you want to do, please get in touch ASAP.
If not sooner. Okay, so
All market update.
yeah, are you going to do this, Rachel?
I think you should take the reins on this one.
Very kind, very kind. Well, I think it's very similar to last year in that we seem to be having a bit of a groundhog day here with these updates. We've got the same issues that we've had for many a month now, and it's led really by the central banks, Bank of England, the Central European Bank, the Federal Reserve in America, to name but three, taking this stupid decision to raise interest rates willy-nilly, month after month after month, and they're still embarking on this program. In itself, it increases inflation because eventually, once these higher rates come to be borne out in terms of people's finance going up, so whether it's buying cars on finance or mortgages or loans, the cost gets more, you've got to divert more of your income to pay for that bill, and therefore you need to have more income in the first place. So if you're employed, you're going for pay rises and all the rest of it. So it's a bit of an ever diminishing circle that they're going on, and they seem hell-bent on breaking the economy. Because they're really wanting companies to lay off workers, companies to close because they can no longer afford the finance at such high rates. And then eventually the workforce will start falling. Nobody will be looking for increases in salaries and wages and all the rest of it, and will rule out inflation that way. Whereas really, as we know, the main culprit of this inflation is the fact that we were locked down for so long, and many parts of the world, we're spending excess capital that we weren't able to spend during the lockdowns. And increasing interest rates just means that it's now harder and harder for those people in employment. If they're not getting a good 10% wage increase, then effectively they're getting a pay cut. So it is a tricky one, but they seem to continue to do this, which sort of makes things a bit difficult, I think, going forward. That inflation is likely to last for a good while longer. Over in America, we can start seeing now the effects of this because, interestingly, the car repossessions that are on finance are at an all-time high. So people are starting to see now that they're being squeezed. In America, it looks like a lot of that saving that was built up during COVID has now been spent. Companies reporting, again, decent profits, but just with warnings that in the future, earnings could dip because of people having less money to spend. So that the markets are hoping that the Federal Reserve and others will start seeing an end to this need to increase interest rates as inflation drops. And so we got a real boom at the beginning of February where people said, whoa, this is it, inflation's under control. The banks are not going to be raising interest rates quite as aggressively, and the markets rallied. And then a couple of days later, the inflation figures came out. Oh dear, we're back to square one. We're going to have more rounds of interest rate rises. So it really is the same old position that we've been in for quite a while now. Generally, the employment market is good. There's more people, for example, or there's fewer people unemployed in the UK than there was at the start of COVID. But there's a missing number of people that just are not in work but not receiving any state benefits, and they just seem to have gone on walkabout. So, yeah, unusually high number of people who are not active in the workplace. And I think really we sort of hopefully going to see a bit better things to come for this year, especially China going back online and exporting more stuff. So that should help. The war in Ukraine, unfortunately, is still going on, but it hasn't spread to other countries. Europe's got over the winter without needing to have power outages, as the doom and gloomsters were saying earlier in the year. So it's a mixed market. It always has been, but again, it's just unfortunately governments taking the wrong action, especially here in the UK with tax rates going up, which is just going to hinder even further. But we do have another budget in a few weeks' time, so we'll see what happens there. If we just have a look at the numbers then, oh no, we're not going to do that, are we? No, we're not. Well, no. We will. We'll cut over to Rachel.
Yeah, I think it's right. Rachel wants to go.
Just a second. So after that very uplifting spiel from Andrew there, what we normally do is have a look at the top 10 holdings within the A.R.D model portfolios and just touch on a couple of the companies that are appearing within there at the moment. These two here on screen, we have Puma Investments of India and Mahindra, both of which I spoke about on the end of the year webinar, and I believe Andrew also touched on them on the market update. So I'm not going to go into again what it is that they're doing, but they are still within the top 10 holdings right now, both very successful companies. India economy is doing very well, so contributors to the portfolios right now. I picked another couple of companies just to focus on some good news stories. So first up, we have LVMH, the luxury goods company. They had a very good year last year. As a result, the share price has been ever increasing. They're now the position of Europe's most valuable company. They've also announced that they're going to be buying back 1.5 billion euros of their own stock. Those shares will then be cancelled, which means that the share price of this company is likely to increase further. So they are increasing up the top 10 ranks in our portfolios right now. They published some very positive end of year results for 2022. The revenue was 79 billion euros and profit from recurring operations of 21 billion euros, both of which were up 23% from the year before. With Louis Vuitton brought in revenue of 20 billion for the first time ever alone. Were you shopping there last year, Andrew?
These shirts do not come from there.
But anyway, as I said, they're doing very well, had a positive year and very hopeful for the year ahead. So some good news from one of our holdings. Next up, we have Games Workshop. This company has appeared in the top 10 holdings before. It dropped out, not so much out of the investment funds, but just out of the top 10. But it's back up there now. It's all on the back of a good run of their stock price recently, because Amazon Studios have secured the rights in a first of its kind deal for Warhammer 40,000. I think that's how you say it. It's a very big deal. We have spoken about it before. They make the miniature war game models.
I don't have them at home, Rachel.
It's a very big deal, so I'm led to believe. But anyways, it's good news because Amazon, like I said, have purchased the rights to this, and they're going to be turning it into either a TV or film production on Amazon Prime. Very much wheels in motion. They've also secured Henry Cavill, who is going to play the lead character in this production. Again, I'm ashamed to say I had to Google who he was, but it turns out he was quite a famous actor. Dan was horrified that I didn't know who he was, but
shocking, Rachel.
You don't recognise him. He's on screen now. He's played various roles in The Witcher, which was another popular programme that bypassed me. But more notably, he was Clark Kent in the Superman films. But
He's Superman as well, Rachel.
There we go then. See, what do I know? Yes, he is going to be playing the lead role, a big fan of Warhammer himself. But yeah, some good news. So watch your screens for that one. And that's as much as I've really got to say right now, Andrew. You just seem shocked by that.
Oh, brilliant. Lovely.
Speechless.
So, moving on to the portfolio performance figures. And we'll just flag these up on screen again. So it's been another sort of disappointing month. January was a good positive month. That was super. And then this month, well, February has been an up and down month, and finished the month fairly flat. Fixed interest has continued to lag, and the assets within that are plagued by continuing high inflation and high interest rates, and it does no good at all for a defensive portfolio or a cautious or a low risk portfolio, and it's got a lot of ground to make up. So as you know, we've been rabbiting on for the best part of 3 years about fixed interest and trying to avoid the sector or have little involvement in it. It will eventually come good, but how long that's going to be, who knows? So the portfolios with the higher equity content, then over the longer term, they're delivering the higher returns. And in terms of volatility, as we said last time, it's the first time I can remember where fixed interest has actually delivered less return than the equity component. So last year when the markets crashed, the fixed interest section fell further than many of the equity funds. And that's a unique occurrence, in my opinion. Anyway, so there's the figures there we've got, and then we can move on now to our special guest star.
Sir, start done.
We will just bring in Andrew, who is going to tell us about the wonderful work at Puma and also
Thank you, Andrew.
Some potential tax tips.
Yep, absolutely. Right, guys. Thank you ever so much for that, Andrew and Rachel, and asking me to come along and do this.
This is your second time as well.
This is my second time, absolutely. I think the last time, it feels like a year ago, it's actually 3 years ago. I think this is frightening, really. But guys, my name's Andrew Derrington, as the guys have explained. I work for a company called Puma Investments, as you now know, and really our world is really to sort of provide you with perhaps offerings that aren't neat, run-of-the-mill investments. So Andrew and Rachel probably talk to you mainly about ISAs and pensions and sort of those sort of things that come across the desk a lot. Really, my world offers you alternative investments, but they also reduce tax liability. So let's cut to the chase. If you have income tax, IHT or capital gains tax issues, then the next 20 minutes is perhaps worth at least listening to. So I'm going to carry on. How do I just click that to that screen there? Right. These two slides are rather laborious, and I'm not going to ask you to look at them, but essentially what they say is everything that we talk about and we provide as product providers is what the FCA describe as high risk. Now, when we go a bit further on in here, you will see that actually a lot of these investments aren't as high risk as you might think they are. But ultimately, what we're trying to do here is twofold. One is make you some money. Two is save you some tax. So it's a two-pronged attack. Now, actually, although these are deemed as high risk, if you look at the performance, which I'll show you over the last few years, a lot of them have done far better than some of the cautious investments that perhaps Andrew mentioned earlier on. So let's move on quite quickly here, because you've seen lots of slides, and the two real taxes I'm going to talk about in detail are inheritance tax and income tax. I'm also going to touch on capital gains tax a little bit towards the end, but let's focus on inheritance tax. Now, this is not, I'm sure there's all ages here watching this the webinar. So it's not. Some of you might have IHT issues, but are too young to worry about them. Some of you may well have parents who are still here, and they might have IHT issues themselves. Anything, of course, that you come across, you think, well, it's worth talking about. Then obviously you need to talk to Andrew and Rachel. They've used us a lot in the last 5 or 6 years, and I'm pleased to say everything's sort of gone well and continue to use us. But in terms of IHT, that slide there really shows you what the opportunities are. Typically, IHT planning revolves around two things: gifts, literally giving away your assets to perhaps children or relatives or whoever it might be, and using trusts. Okay, the two reasons why people sort of might be reticent to do either of those two things are: number one, as soon as you've gifted money away or put it into a trust, it's outside of your control. You can't get it back. Number two is typically, in order to reduce inheritance tax, putting assets into these sort of vehicles or gifting it away takes 7 years to get the money completely outside of the IHT net. Now, a number of years ago, a relief was brought in the mid-70s, believe it or not, called business relief. And that really now, cutting to the chase, enables you to buy shares in different companies, trading companies. And once you've held them for 2 years and you hold them on death, then they are outside of the IHT net. So they solve the two problems in a way, perhaps, that gifts and trusts throw up. In other words, number one, it takes 2 years to get the money out of the IHT net. And B, perhaps more importantly, is you can have the money back if you ever wanted it. You have complete access and control. All you're doing is moving money from a bank account or a share portfolio, wherever it might be, liquidating it and moving it into assets that qualify for IHT relief after 2 years. Now, typically, as I
covering off that slide, I think I've talked about that really. Quick IHT exemption, greater access and control, simplicity. We're not doing any complex legal structures here, and you can have regular withdrawals as you wish. Now, typically, there are two sorts of underlying investments that firms like Puma to provide to A.R.D clients. The first one here is something that we provide called Puma Heritage. Now, all this is we as providers try and find an asset class that delivers you A, the 2-year relief, but B, a very steady, and you might call it boring, and you might call it predictable return, but that's fine when we're talking about inheritance tax. All Heritage does is make short-term first charge property loans. So we lend money to go and build hotels, residential accommodation, student accommodation, whatever it might be. We've been doing it since 2005, believe it or not. So it's a well-trodden trade for us through the last recession, through COVID, and through the current economic climate. We've never lost any money. We've lent over £1 billion now, and we typically charge an interest rate of somewhere between 7 and 8%, and they've always delivered a return of between 3 and 4. Okay, and that's what that slide shows you. Very predictable, steady graph. And people, perhaps when they get older into their perhaps 70s and 80s, are looking at IHT planning, then that sort of steady return plus 2-year relief and having the ability to get money back can be quite attractive. Okay, now some people, as you can imagine, will want a higher return than that, and that's where you may have come across these before, where people want to do 2-year IHT planning, use a portfolio of companies listed on the alternative investment market. Now, the first point to make about that is people think, oh, they get scared off by this word alternative. Alternative doesn't mean small. All right. We have a portfolio here of actually 36 companies, and the average market cap is around £500 million. So a lot of these companies would happily fit or could sit themselves on the FTSE 250. It's almost a mid-cap portfolio. Yes, there's some smaller caps in there as well, but we don't look at anything of a market cap of less than £50 million. So it gives you an idea of the sort of size of companies you're dealing with here. So here you have literally a portfolio of stocks and shares that we manage, and we've done that since June 2014. And you can see there some statistics and results that we've delivered. We compare it to a FTSE All AIM index, which is irrelevant really, because you're not going to have an All AIM share portfolio, but you might have a FTSE sort of tracker, which we compared to that at the bottom. But let's look at some figures. Since we started, our compound annual growth rate up until December, the end of December 2022, was 7.58. Now, clearly there's some humps and bumps to get there, but that's broadly what we deliver. Obviously, remembering there's the 2-year relief and the ability to have this money back. All right. Now, if you look at the graph a bit further down, you can see our numbers at the top, the blue line. The bumps where we've suffered are: one, when Brexit was announced originally, bounced back quite quickly. 2, a number of providers, and we were one, had a company in there called Patisserie Holdings, Patisserie Valerie Cake Shops. You might have come across that. It still trades, but it's not a name anymore. Obviously, COVID in 2020, but believe it or not, although there was a 30% drop, by the end of that year in 2020, we were actually up 3%. So it rebounded very, very quickly. Last year wasn't an easy year. We performed, I think, generally very well compared to our competitors. We were a 14% down over the year. And again, not bad, and a solid start to this year. So there's going to be humps and bumps with an AIM portfolio, but the 2-year relief of prize, and hopefully you would generate a bigger return than perhaps 3 to 4 that we talked about with Heritage. It's on platforms. It's on the Aberdeen wrap that the guys mentioned earlier on. The other big thing, given its tax year end, and Andrew talked about ISAs earlier on, you can hold these stocks within an ISA. So you could do your current £20,000 ISA with AIM stocks, effectively creating yourself an IHT-free ISA, or transfer existing funds you've got within ISAs into AIM. Okay, so you might have built a big portfolio up in your ISAs, transferring perhaps a little bit of that into AIM could take it outside of the IHT net and hopefully deliver a nice return. Okay, so moving on from IHT, let's get to the sort of the major bit to finish off really is tax year-end planning. Very relevant in my world between now and April the 5th is something called venture capital trusts, VCTs, which, if you like, is a bit of an alternative to a pension. All right. Now, VCTs are effectively a VCT, a venture capital trust, is a company. That's all it is. And you apply for shares and buy shares in that company. It then holds shares in a portfolio of smaller companies. Now, when I say smaller companies, these are smaller companies. They are not, certainly in our world, startups, but they can be worth no more than £15 million and have no more than 250 employees. It isn't. We have to invest in the first 7 years of the trade. We do invest in very established companies, okay? So they are well on their way and performing well, but they're not the similar size to perhaps the ones I talked about in the AIM portfolio. But what do the government thank you for doing this? Well, when you buy shares in a VCT, they give you whatever you put in. You put £100 in, they'll give you £30 back. Now that £30, that 30% tax relief, is income tax that you've suffered this tax year, in the year you make the VCT contribution. So you can imagine between now and April the 5th, yes, you're looking at your ISAs and you're looking at your pension contributions, but people are also making sure they do perhaps some VCT to mop up the income tax that you've suffered this year. Now, you haven't done your tax return yet, but you've probably done it for last year with a bit of luck. And so you look at last year's return and what was my liability after I've made my pension contributions, done everything, divide it by 30%, and perhaps that's what you might use to invest in a VCT. So we get our tax relief up front. That's very nice. We have to hold these for 5 to 6 years. Just so you're aware, you can come out before, but you wouldn't, because if you do, you lose your tax relief. Over that 5-year period, you will receive some tax-free dividends. And I'll show you some performance in a minute. And after 5 to 6 years, you can come out of the VCT. And a lot of people come out because they want to go back in again and get a further slug of 30% tax relief. All right. So between now and April, this is very much VCT season, as you can imagine. In terms of the people, you guys on the webinar now, who would this apply to? Clearly, people who do incur a reasonable amount of income tax. Although the minimum, believe it or not, is £3,000. So actually, you only need to suffer £900 of income tax this year in order to be able to do it. But high earners, you can see at the top there, clearly people who are perhaps maxed out on their pension, be it from an annual allowance or lifetime allowance. Business owners, if you happen to be built a lot of money up in a company and you want to take it out and you've got to declare a dividend, you create income tax there. We can mop it up using a VCT. You might surrender a bond and create an income tax charge there. And rental income, I think, is there on the bottom right. If you earn rental income from a property, then again, you can't make a pension contribution to reduce that, but you could do a VCT. So give you an idea of the sorts of people that might be able to use it. Bit of performance as well. This is driven by tax, but what sort of return are we making for you? We started our flagship VCT 4.5, nearly 5 years ago now. People put £1 in. Their value of that VCT now is £1.30. All right, per pound you put in, and you've had also 16.5 pence worth of dividends. So your £1 really now is worth 1.47 in terms of the total return over 4.5 to 5 years. Plus, remember, you had 30% back from HMRC at the start. So you've kind of gone from 70 to £1.47 over 4.5, 5 years. So A, some tax relief, but B, some very nice return as well. And that product is available between now and April 5. All right, a couple of companies in there just to give you an idea. Cameramatics, there you can see that slide there is a business that makes sophisticated cameras for fleets of trucks. All right, so for driver safety and vehicle safety. We had an offer for that last year of 2 times what we invested in it. We didn't take it because we feel there's a lot more value to be had in that particular company. So that's one. This one we may well exit this year. A company called Influencer, which brings together sort of well-known celebrities, personalities, whatever you, to companies and help grow their presence, their brand, and ultimately their sales and performance. And that continues to perform well. All right. So really, the 2 key bits today, guys, are IHT and income tax. All right. Now I'm going to just touch on one thing. We have another thing in our books called EIS, Enterprise Investment Scheme. Keeping it simple, it's the underlying investment is the same as the VCT. So think about those smaller companies and that sort of performance. We do that with EIS. Now, why would you do EIS as opposed to VCT? It's the same sort of investment. It's structured slightly differently. So what it can do is defer any capital gains you have. So if any of you have sold assets, be it shares, land, or you're about to sell an asset or a business, and you're facing capital gains tax. Andrew talked about planning around maybe selling assets this year to make use of the higher nil rate band this year. But you incur gains, then we can defer that capital gains tax using these sorts of investments, and we can at the same time actually get some IHT relief as well. I'm not going to go into more detail there, but if those are the sorts of issues that you're facing, it may well be worth a note or a call or whatever to the guys here at A.R.D. All right. So little bit of background on Puma. We've been around for since 1985, actually, our parent company called Shore Capital, but Puma really started in 2000 rather. I've been here 6.5, 7 years now, and obviously know the guys at A.R.D very well, and they've used us for a number of investments. There you can see on the left-hand side, growth funding for us being VCT and EIS. The two things in the middle are pure property finance being Puma Heritage, which we spoke about right at the start of my session, 3 to 4% steady growth with the IHT relief, and then quoted equities being our AIM portfolio, perhaps a higher return, a little bit more volatility, but we've got that AIM angle as well. All right, so really that's probably enough from me, unless any questions are and they're all going to be difficult, I'm sure, from the guys. Shall I move over?
That's great. Thank you very much for that, Andrew. That was a very educated talk.
Very interesting.
Yes. So we have a check, see if there's any questions coming in behind the scenes. But if you do have any questions for Andrew or ourselves, please let us know. What we probably do is look to answer those individually once the webinar's concluded.
Again, if you're not watching this live and watching a recording later, please do just get in touch and we'll answer your questions as and when.
Yes, so that's good. Anything else?
Not from me, no.
No, I think we covered everything today. So thank you very much for coming along.
Pleasure. Thank you. Yeah, great.
It's
Thank you,
lovely to
guys.
see you
Thank
again.
you.
And what we'll probably do is the next webinar is probably scheduled for May. And if you've got any topics you'd like to be included, please let us know, and we'll look forward to including those within the next presentation. But on behalf of us all here, thank you very much for attending today. It's been lovely catching up with you, and we'll hope to see you either in person in the office or via Zoom or any other form of contact really soon.